Their bond market's telling you that. Bond yields have been in free fall because there's a debt deflation going on in China. They need dollars and they need to stimulate. So, because they've got issuance going on. So it just feels like there's a grand bargain to be met. And it surprises me that people think that they want to devalue their currency. They don't want to do that because that just encourages capital flight out of China and makes it ugly.
Hey guys, welcome to Everyday Finance. Raoul Pal presents an in-depth analysis of the macroeconomic forces that are reshaping global finance. These forces include inflation, deflation, that is driven by technology and demographics, and the gradual but inevitable debasement of fiat currencies. Furthermore, according to Pal, these are not merely economic tendencies. Rather, they are structural shifts that almost certainly will result in the debasement of the currency. A bold blueprint for the operation of future markets is presented by him. These markets will be digital, decentralized, and driven by assets that are resistant to dilution, such as Bitcoin. Cryptocurrency is currently emerging not only as an alternative, but also as a necessity, as traditional financial tools are losing their competitive edge. In addition to being a hedge and a lifeboat, it has the potential to be the focal point of a new economic system. Pal is of the opinion that we are not going back to the period of time when monetary policy and centralized control were prevalent. The future that we are moving into is one in which programmable value, financial sovereignty, and resistance to inflation will be the norm that prevail. He should explain everything to us, shall we? Let's listen him.
Take a look at the trade statistics between China and Mexico after the first round of tariffs, right? If you don't implement tariffs on a global scale,
which is what they're doing this time. They've even talked about it. I think it was Besson talking about the arbitrage, which is why they're like putting tariffs on like the Marshall Islands and stuff like that. It's like you're not going to reroute your shit through somewhere else.
No, but if this tariffs regime is more permanent in nature, as we basically concluded just a short while ago, Raoul, China will have to alter their strategy because they've been a manufacturing hub and they've exported to the Western consumer via Vietnam, Mexico, etc. for a while. So they will have to come up with ways to prop up the local consumption. And they cannot do that with the dollar trading as strong as it is right now versus the Chinese yuan. As we speak, the dollar is making new all-time highs versus the Chinese currency. So that is what they will have to ask for.
And that's my view, but it's interesting to see Arthur Hayes yesterday saying, oh no, they're going to devalue their currency. I'm like, they can't. They bankrupt their entire property sector because it has dollar debts. 50% of Chinese debts are dollars.
And that is exactly why they're not going to sell their treasuries, because that would lead to an upwards pressure on the dollar versus the Chinese currency, exactly what they do not need. So I think they will ultimately accept, and that's why they're not budging right now. They'll accept that tariffs are permanently high against them. But in return for the US administration not escalating and escalating and escalating, they'll end up deciding to buy some more treasuries in return for some dollar liquidity deal. Basically some sort of that's basically some sort of like Mar-a-Lago Accord. I think that's where it will end up when the tariff regime is fierce enough for them to get to the table.
Because they have to stimulate. Their bond market's telling you that. Bond yields have been in free fall because there's a debt deflation going on in China. They need dollars and they need to stimulate. So, because they've got issuance going on. So it just feels like there's a grand bargain to be met. And it surprises me that people think that they want to devalue their currency. They don't want to do that because that just encourages capital flight out of China and makes it ugly.
Yeah. If they do that, it's not my base case, but if they do that, watch Bitcoin and gold. and the likes, right? It's another debasement bet in case. So it basically just underscores the point.
So let's talk about asset allocation then. In the next, let's do time horizon, because if not, everybody gets confused. Let's talk about short-term time horizon, shorter term, like over the next couple of months, and then, where is your kind of structural view over the next year, what you want to own?
Yeah. So, my working thesis right now is that I'd like to see the liquidity conditions deteriorate enough for the Fed Reserve to have a perfect excuse to get involved.
And you're talking here about kind of plumbing liquidity.
Yes. And I think we're getting there, right? With the markets that we've seen over the past weeks. So as soon as you see early signs of the Federal Reserve getting involved in this, it's basically your clue to reload on risk. Until we see that, and that's what I've done here. I'm short commodities and long bonds. I think risk reward is okay being long bonds here. And now we're talking very, very, the part that I tactically manage, and it's been okay for me over the past months to take that view. Looking 12 months ahead, I would put a very, very high probability on some sort of global coordinated liquidity response to what's ongoing. And we kind of know the drill when that happens. All of the debasement bets will be back in fashion as soon as we see the M2 going up on a global scale. We're basically already seeing it, actually. The early signs of it are there. It will probably not be, if they do not coordinate in a coordinated fashion add liquidity, it will not be the huge bull market that we're all hoping for, but it will still be a bull market, given what we know already now.
QCP Capital is raising a red flag despite the fact that Bitcoin recently reached a high of $82,700. This rally, in their opinion, has the potential to be a textbook example of a bull trap, and the timing could not be more delicate. There has been a resurgence in geopolitical tensions, particularly between the United States of America and China. The announcement made by President Trump that he would be pausing most trade tariffs for a period of 90 days provided a temporary boost to the markets. However, China was expressly excluded from the relief that was provided. According to analysts, Beijing is getting ready to launch a strong counterattack. In the event that retaliation is speedy, the current excitement surrounding cryptocurrencies may vanish in an instant. But there is another side to it. Bitcoin is frequently the destination of capital during times of geopolitical tension and currency instability, such as when the yuan of China is experiencing a decline in value. Based on the explanation provided by Sina, co-founder of 21st Capital, it is possible that we are witnessing the transformation of Bitcoin from a hedge asset to a financial necessity, particularly in economies that are losing trust in fiat systems. Despite the fact that Bitcoin is gaining momentum, there are analysts who are warning that the long-term bottom may not yet be established. The influence of volatility, which is fueled by political and economic unpredictability, continues to be significant. Watch more insights.
And so tactically, you'll have bets where you're long bonds, short commodities. Structurally, because of your debasement thesis, liquidity thesis, you're going to be wanting to be long duration assets, crypto, tech, that kind of stuff as a general trade, I guess.
Yeah,
as a structural book.
But I prefer crypto to the Max 7s here, due to the discussions we had on IT infrastructure, security concerns from Europe, and all of that. So if I should pick between the two, I would certainly lean towards crypto.
You don't tariff crypto.
No, how?
Exactly.
So I think that's a valid point here, that tariffs will impact Max 7 more than crypto ultimately. Let's see whether we get that big disconnect between crypto and the Max 7s. I sincerely hope so over the coming years. And I think that's basically my main takeaway. what I've struggled with historically, and that's something that I've had to, for good and for bad, teach myself through a couple of drawdowns, is to just not look at it when it looks like this. My crypto holdings.
I don't even look at it. I don't look at the P&L.
Yep. I use Kraken, and I haven't been logged into Kraken since mid-January.
Yeah.
And I sincerely mean it.
Yeah, no, I'm the same. I don't look at it.
I haven't told my wife about how the developments are either, because then I would be under pressure, right? So, that's...
But we're all learning how to have longer duration in a high volatility asset, right? It's not something we learned. You, as a money manager, because you run a hedge fund as well, you can't do that. It's not a mandate for anybody.
No.
But the volatility is what drives the returns.
Yes. And here's the main takeaway, Raoul, because, I've been running a hedge fund through this mess. And in a hedge fund, you're not allowed to make large drawdowns on behalf of your clients. So you need to watch it. And what's very difficult is to watch something that trades against you and not do something. The human mind cannot stand watching that. So if you have if you run your own money and you're allowed to make drawdowns on behalf of yourself, right? No one cares outside of yourself. And if your time horizon allows for a drawdown, don't watch it, because you cannot stand watching it. So
how I deal with that is that obviously I watch it like a hawk. I've got hourly charts of crypto and tech and whatever, but I don't look at my P&L.
Yeah. Okay.
So I can be involved in the market and the hopes and dreams and the fears and the horror and all of that stuff as a market, but I don't look at my P&L, because if not, you connect the two and it's like, holy shit, because your P&L moves around a lot.
Yeah, it does. It really does. So I'm involved in a couple of coins with pretty decent size, and that's something I just intend on not looking at. Then obviously, as you always allude to, Raoul, make sure that you take lifestyle chips off the table. I've also done that late last year. I aced that MicroStrategy trade and never reinvested it.
But how do you manage, because you're running a portfolio which is higher turnover, which is the fund? You've got one mindset for that.
Yeah.
How do you deal with the dual mindset?
So in the fund, I allow nowcasting to take most of my decisions, right? Because it's actually very tricky when you have to trade and when you have to navigate drawdowns. It's very tricky to not get emotionally involved in that on a running basis. So I prefer some sort of system-based setup. Yes. So I now cast inflation, I now cast growth, I now cast liquidity conditions, and it will provide me with a signal on whether to lean bullish or bearish, very, 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 very near term. And that model framework is what I use to take short-term decisions. That framework will not tell you anything about what happens in 3 months from now. Nothing. It just tells you something about the present. And when you manage risk with, drawdown considerations, you have to stay in the present. While if you manage your own portfolio with a larger risk appetite and with a larger appetite for volatility, you need to look at the business cycle and look ahead, right?
Yeah, you have to live in the future with these assets, and the present with a real-time P&L for clients.
Yes. But to be honest, it's been tricky to navigate those two time horizons for me this year.
Really hard. Very few people can do it. Stan Druckenmiller is one of the people who can do both.
Yeah.
It's a really hard skill set. I can't do both. I just can't do it.
Following the confirmation by Trump of a 90-day pause on most tariffs, with the exception of those that target China, the markets roared back to life. A rise of 4.6% in less than an hour brought the price of Bitcoin to $81,300. This was followed by a 6.1% increase in Ethereum's price to $1,600 and a 10% increase in XRP's price to $2.30. Even the stock market joined in on the rally. The S&P 500 and Dow both rose by more than 5%, and the Nasdaq soared by more than 8%. Trump clarified in a post on Truth Social that although reciprocal tariffs will be reduced during the pause, imports from China will be subject to a harsh tariff of 125% beginning immediately. To escalate the already volatile standoff, China responded by imposing tariffs of 84% on goods imported from the United States. Even though there has been a rally, the market is still plagued by uncertainty. Just one day earlier, $326 million was taken out of spot Bitcoin exchange-traded funds, ETFs, with BlackRock alone contributing $253 million, highlighting the caution of investors. Treasury Secretary Scott Bessent intervened to calm the markets by stating that the pause was a strategic move and not a reaction to falling stock prices. Strong cooperation from United States allies was emphasized by him. Despite the fact that the overall cryptocurrency market increased by 3.1% to $2.63 trillion, it is still lower than the $2.74 trillion. It was the previous week before tariffs sent shockwaves through risk assets. Despite the fact that the pause has provided some breathing room, the next move from China could potentially change everything once more. The markets are currently in a positive position. However, nobody is letting their guard down. Thanks for watching.